This is being recorded for the Absolute Alerts Discord. The link is in the bio. So feel free to join our Discord. Feel free to subscribe and like the video. We are constantly giving call-outs and we're always looking for new people to make money with us. Risk management. When you think of risk management, the first thing that comes to my mind personally, out of my experience, is how do you invest while minimizing the chance of you losing money? I mean, basically, it explains itself. It's risk management. Now, there's several ways that you can manage the risk when you trade. One of the main ways that I prefer is a stop loss, but that doesn't always apply. For example, with Parabolic Stocks, if you are buying into a stock that's parabolic, like today we went for NAOV, it got halted a few times, and there were other stocks that we played this week that got halted a few times. And after the halts, you saw sometimes that the stock could drop by 50 cents. So setting a stop loss on a parabolic stock, I wouldn't really recommend it. At least that's my opinion. What I do in those situations is I constantly watch. I'm constantly watching the charts. Every time that the halt begins, I time it so I know when it's going to end. Halts the longest I've ever seen a halt was about 15 minutes. But there is no set specific time. It could be anywhere from 5 minutes. The average amount of time that a halt lasts is 10 minutes. But what you need to do is you need to watch a stock. For example, after the halt, if you see it starts plummeting and that's it, it went parabolic, it got halted, now it's done, that's when you sell. But make sure you sell for the profit. However, if you set a stop loss and after the halt, the stock drops because somebody sold off, and there's always going to be that one person that sells off because they want to lock in their profits. So after every halt, there's always going to be the stock going down for at least a little bit. You are taking a risk of getting out of the trade earlier than you actually want to. So that's why I never recommend setting stop losses on parabolic stocks that are getting halted. On stocks that you're swing trading, now that's a different story. With that, the risk management is a little different because that is where you do want to set a stop loss. The kind of stop losses you want to set, and I've been asked it several times, like, what is my usual stop loss? There's no exact answer to where your stop loss should be. And you're never going to be able to get an exact number, but I prefer to use percentages. Now, when I use percentages, it's because I'm trading on amounts that are a little higher. So for me, for example, if I buy in for $10,000 worth of shares, 1% stop loss for me is $1,000. So you gotta, technically it would be 100, but yeah, that's the way you do it with high volumes of shares or high amounts of money. The standard, I guess you would say the general rule of thumb is to set your stop loss to anywhere between 1% to 2% if you're investing a lot. However, if you are investing $300 and you set a stop loss of 25 cents, so the stock goes down 25 cents, there's a good chance that you're going to get kicked out of the stock before you actually make any real profit. That's my opinion on it. Aside from stop losses, another way to mitigate your risk is using take profit points. And I went over this on my last video. You don't have to have just one take profit point. As Athletic Being always tells people, scale out of a position. For example, today, NAOV, I think I told you guys to buy in at about $1.44. So you could have scaled out at $2.44. So you would have been up a dollar on X amount of shares that you bought. You would have, say, taken off 50% of your position. And at this point now, you know that, even if it falls a little bit after that, you already made a profit. You've locked in a profit. And that is one of the biggest mistakes that I see people make, where I see you guys saying things like, I was up in the morning, I was up in the afternoon, and towards the end of the day, I finished red. I don't know what's wrong with me, this, that. It's because you're doing what, is referred to as chasing. You're chasing the price point. The one thing you never want to do is you never want to chase. You never know how a stock is going to react, especially with some of the stocks that we've been playing lately, which are biomed stocks. Those are the most volatile stocks that you will ever see. I mean, if we pull up a stock, analyze XBIO, it'll tell you the volatility, it'll tell you everything about the stock over here. If you're using margin, so on and so forth, over here, profitability, volatility, you need to look at these things. But the point I'm trying to make with this is biomed stocks tend to be extremely volatile. That's why you see things like NURO for this week, where it went from $5 to $10 up to $40 and down to 20, and then the next day back to 40. So, volatility you have to take into account, just because of the fact that when it comes to these things, you could lose a lot of money very, very quickly. I mean, if you buy in at $20 and this is a, stock that just jumped up, it could fall back down just as easily. It's not a hard thing to do. Same thing with XBIO today. It got halted 3 times. It did two reversals. Actually, I would say 3, because it did another small little mini reversal in after hours. Same thing applies for I think it was NRPX. It, pre-market went up to 27, then it dropped down to 18, then it went back up to 27. So that's when your stop losses could help you, but you still got to watch them, and you always got to keep track of them, because you don't want to get kicked out of the trade earlier than you actually want. You also don't want to, sell off by using a take profit point if you see that the stock is still going up. So when it comes to parabolic stocks, I always say manual work is best. If you don't have the time, if you're at work, for example, then yes, you could use them and just take the profit that you make, and that's it. Another way to, use a stop loss point a little more effectively and a take profit point is by doing your technical analysis. So if you look at a stock, and I'll do this with a chart pulled up so you guys can see the way I look at it. NRXB. So I would pull up the 1-day, 1-minute chart. I'd zoom in and go right to, where I feel comfortable. And then I would see that over here on the upper band, the high points are about $27.30. The low point is about $26.23, and the average for it is about $26.71. And it did close around the average, even though you see this, last candlestick, but it did close at 26.47 on the ask, and on the bid 26.31. So you could always use, the Keltner channel bands, and I will quickly go over my settings for that as well, on determining, where you should buy in if you're scalping, or where you should be setting your stop loss, take profits and things like that. Me personally, I never set take profits unless it's a long-term play, but I do use stop losses on swing trades, and I do use stop losses on stocks that I know are not that volatile. For me, a volatile stock is something like today with NRXP, where it went up by $8.32, during market hours. That's a very volatile stock. It's not predictable. I think the lowest today it went during market hours. Let's see, 2018 right here. Now, say you bought this stock pre-market. Let's go to about 7 a.m., which is when most people start trading, unless you're using Webull. So 7 a.m., it was around 2177. Now, what you could have done is you could have held it and you could have sold it for, say, over here, 2482, made a profit, and then it went on a downhill. Now, if you would have rebought again over here, you could have bought in at $16.69. The reason why is what I always tell you guys in the chats: when the market opens on stocks like these that are going up high and they're going up fast, you always got to watch for a dip and rip. The stock price is going to dip, and that's when everybody who wants to get in on the play, but they're cheap and they set, a buy price where they're trying to get in as cheap as possible, that's when all those buy orders execute. Once those buy orders execute, essentially when the market opens, what happens is it's a fight. It's a fight for control of the market between the bulls and the bears. Now, over here, obviously, we could see that at market open, the bears were winning. The price, started plummeting before even the market opened. People were taking their profits. They wanted to be safe. They wanted to make sure that they get out of this trade with, staying green. And then once it hit just around, like I said, the lower band, always watch the lower Kelder band, that's when it shot back up. And it shot up from about $16.64. And if you would have held it the way I did, for example, today, you would have closed out at about $26.40, between $26.30 to $26.47. You could have sold, I think, after hours, the high was $30 over here. So that's one of the main things that you got to watch for. When it comes to market opens, always watch the dip and rip scenario. Sometimes it's a little tricky. Like you will think that the stock is going up. The second the market opens, it's gonna shoot up. But don't believe into that, don't buy into that, because that is not true. I've seen it so many times where the stock market opened, I bought a stock and I made, say, $4 per share in the first 3 minutes. But I held until, say, 9:37. By 9:37, I was already losing about $1,000. Why? Because the second the stock market opened, the stock price shot up. And every single time the stock breaks a new high, what happens is somebody's sell gets triggered. Just like this, whenever a stock hits a new low, somebody's buy gets triggered. Every time a stock hits a new high, somebody's sell gets triggered. And the way it ends up working out is it's based on volume. If there are more buyers than there are sellers, then the price is going to keep breaking the roof. It's going to keep breaking resistance. It's going to keep going up. So that's why every time, like we say, if it breaks this price point, we add. That's called a momentum play. And momentum plays is we already know that if it keeps breaking its resistance, that means that the stock is on a bullish trend. And with bullish trend stocks, you know that the price is going to continuously go up. There's a slight risk, yes, of course, that it's going to go down. It's going to hit somebody's sell point. Hey, somebody could be holding 10,000 shares and they decide to get rid of them. They want to take their profits now. But that's why we always say scale out. Once you say get 10% returns on your original investment, take a little piece off, keep the rest on. And the more that it breaks that resistance ceiling, the higher the chances are that you're gonna be making profit, you're gonna be making money, and you don't have to worry about it. One of the ways that you could always tell that these things are happening, and I'm sure you guys have seen me say this in the chat, is look for the higher high and higher low setup. And this is exactly what it looks like. All the highs are getting higher, and all the lows, the red candles, are getting higher as well. Even over here, this looks like it's a dip, but it's really not, because look at this uptrend over here. All this was right here is somebody sold off because they made a nice profit, and that's it. But right after this, the highs are again, they're higher than the lows, and it keeps going. And if once you start getting used to reading these chart patterns, you're going to be able to trade a lot more efficiently, and you'll be able to know when to pull out and basically how to scalp stocks, which is ultimately what you want to get to. Obviously, scalping stocks, it takes a certain amount of capital in your account, because this way, you could execute maybe 30, 40 trades a day. You really never know how many trades you're going to go through. There's been times where I've went through over 500 trades in one day, but each time I traded, I made, say, 10 cents profit. But because I bought 1,000 shares, 10 cents, that's about $100. So over here, as you can see, the lines don't lie. Every time it hits the bottom one, it goes back up. Over here, we're staying around the average, hits bottom again over here, goes back to the average, hits bottom over here, goes back to the average. That's how you scalp. For when it comes to scalping, you buy in at the low levels, you sell at average, or you could wait to sell at the highs. Now, a scalp would technically be buying about here, selling here. That's a scalp. A day trade would be buying here and selling here, because scalping, it's more of, you're in the position for no more than a minute or two. You take a quick profit and you keep doing it. You keep doing it. Just, repeat, repeat, repeat. Day trading, it's the same thing as scalping. Scalping basically is a derivative of day trading, except with day trading, you buy and sell in the same day, but you could hold up to an hour. You could hold up to 2 hours. I often tell you guys, buy the lunchtime dip. The lunchtime dip is also an amazing time to buy. I don't care what stock you're getting. Even when it comes to expensive stocks, lunchtime, there's no exceptions. For example, NVIDIA, this is one of the positions that I'm in. Let me make this one chart so it's easier to see. Right over here, this was the lunchtime dip. And if you would have bought in right here, you would have got in for about 190, 275. And you could have sold over here as a day trade for 195.25. Now, say you don't have the, capital to play with stocks like this, there is a way for you to still be involved and actually, be able to play these stocks. And that's when we transition into options. So you're able to play with shares that are not $5, $10, but shares that go more into, say, $50 to $150. Options, they are gonna open that world to you. And on top of all that, in my opinion, it's one of the quicker ways to grow your portfolio. But before we go to options, I want to finish up with the section of risk management. So, there's a couple of points that you want to remember when you set stop losses and when you set take profits. You want to always use like longer term moving averages for more volatile stocks to reduce the chance that, you're going to hit your stop loss. So If you use a longer term moving average, I prefer to use 10 and 40, but people also recommend using a 50 EMA, 100 EMA, 200 EMA on stocks like NVDA, for example. A 200 EMA it's a godsend. I'm not sure if I have it enabled right now. No, so I will show you guys what I mean. So I'll add an exponential moving average. I'll go to my settings. And I'll set the length. And the length is basically how many days it looks back to 200. Click OK, apply. I have to do one thing. Let's set this to a color that's going to be easily recognizable. We'll do yellow, even though we already have a yellow. So let's do no this thing, pink. I think I have a pink also. Apply. Okay, so this is the 200-day moving average. When the price is below the 200-day moving average, that is a very clear sign that the stock is underpriced. It's in a downtrend. Once it crosses above the 200 EMA, that's when you know that the stock is actually at its current value, and there's a good chance that you are gonna make money on it as long as it stays above the 200 EMA. But as you can see over here, we were right above the 200 EMA on this stock. The second we crossed over and we went below the 200 EMA, that's when this dip happened. So if you're doing swing trading where you're holding a position that is, say, 5 days, 7 days long, or it's in your IRA account and you want to hold it for a couple of months, if you see that you're about to go under the 200 EMA, expect a fall, because it's going to happen. Now, you could either, of course, ride it, ride through it, which I did because I'm not selling my NVIDIA shares, or you could sell right about here, take your profit, then you wait, just wait it out, see when the decline is pretty much done, and buy in cheaper. So the low is 192.50. You could have bought in, you could have sold over here at about $197 today. And then you could have bought in again at 192.50. And then, of course, if you're day trading, sold it when it got back to the high. So, that's one of the ways to manage your risk is, use these things that are available to you. Remember, indicators are not going to help you. They're not going to make you always win money. They're just there to analyze the price and give you a basic idea of where it's headed to next, which I guess in a way answers your guys' question that you ask me pretty often. How do I choose my stocks? I choose my stocks by looking at them the same way that I'm showing you right now. Like if I see that a stock is at its 52-week low and I see that it's coming up to the point where it's about to go above its 200 EMA, then what I do, I'm going to call it out and say, look, I'm adding a position here. Why? Because I know that once it crosses above that line, I'll make some profit. And as Athletic always says, every penny counts. So even if your profit is, 10 cents per share, it's still money. You still make money for that day. That should be more than enough. If you could make, $300 a day by trading for 2 hours, I don't know a single person who will complain about that. So now another one, you always want to adjust your moving averages to match the target price ranges, right? Longer targets should use longer moving averages. So if you're swing trading, you could use, say, a 20 and a 50. If you're day trading, you could use a 10 and a 40. If you're doing a long hold position, you could look at the 200 EMA. But if you're day trading and you're looking at a 200 EMA, then that's not always going to be accurate. I mean, as a matter of fact, it's, most of the time it's going to be a little misleading. Why? Because you're day trading. You know, as a day trader over here, even though it is below the 200 EMA, I would still buy here, sell here. You know, I'd wait for another dip like over here, buy here, sell here. You know, buy here again, sell here again. And that's what day traders do. They see the dip, they buy into the low, and then they sell at the high. I told you guys I'll show you my Keltner channel setup. I've showed it before, but I'm going to go over it again because I've been asked this. So I want to make sure that everybody understands, you know, exactly what setup I use on a daily basis. So my usual setup without the 200 EMA for my day and swing trading is this right here. The RSI, I don't change. I leave it exactly the way it is. That's relative strength index. MACD, I do not change any settings on. I leave it the way it is. I add two simple moving averages, one for 10 and one for 40. Now the default is 9. And I've been keeping up with the YouTube trends. I know that there's a lot of, you know, hype going on right now about the 9-day moving average, but it's really not a big difference. I think it's more of just a marketing stunt, because the only difference between the 9-day EMA or SMA and the 10-day EMA SMA is 1 day. It's not really going to make that big of a difference. So, you know, all these, if you see advertisements saying, you know, I got this great new 9-day EMA strategy, they're just trying to get your attention. Why? Because every single person on YouTube, they're trying to get views, they're trying to get subscribers, they're trying to get likes. I'm saying this because it's the truth. And, you know, if one of the people that watches this video is another content producer, they're going to probably hate me for revealing the truth, but that's what it is. You know, when shit hits the fan, that's what it comes down to. Now, the Keltner channels I use, the setup, the only thing I change is the factor. I think the default factor for Keltner channels is 1.5. I set it to 2.25. And the factor, what it is the, you know, the pricing distance between each band, the top, average, and bottom. For those of you on Thinkorswim, if you need a more detailed explanation, you could always click on things over here. You know, the factor by which your ATR value is multiplied to calculate the distance. So basically, it's just a change in the price. It gives you a little more room. And the reason why I like that is because at the standard 1.5, I feel like it doesn't really take into account the fact that prices sometimes could dip just because of bad news. You know, if a bad article comes out for a biomed company, you could just lose a lot of money. But even for tech companies, when bad news comes out, like for example, the ticker DIDI, they are having problems right now with Chinese administrators, and their stock is going down. However, Didi is basically the Uber of China. Their platform was huge until China actually removed it from the Chinese marketplace and banned it. That's why their stock price dropped. And that's one of the reasons why today I said I think it's an amazing long hold play. And the reason why is because eventually all these things are going to work out. It's a multi-billion-dollar company. You know, right now it's $8.06. It's dirt cheap. I'm pretty sure that within the next 3 months, this stock will be worth, I would say, at least $20. If we look back about 180 days, it was 18. And that's when this whole, you know, Chinese drama started, and it's just been sliding ever since. And this stock had a direct effect on Chinese electric vehicle makers. And the reason why I bring that up is because XBIO, for example, ran up today and I made another call out on another stock, was XTLB. If XBIO goes up, XTLB goes up. If XBIO goes down, XTLB goes down. Now, Didi, since it's like the Chinese Uber, when Didi had these problems happen, Neo dropped. So when Didi dropped over here, if we pull up Neo, which is the Chinese EV maker, let's go to small chart over here. It started dropping also. It was at a high of 55, hit a low of $40. Why? Because they got banned from the Chinese marketplace. If we go to XBIO, as that went up, the other stock that I just mentioned, which was XTLB, XTLB, as you could see, it also went up today. So, some of these stocks, it's like partnerships. If one goes up, the other goes up. And the reason why that happens is because they both belong to the same exact sector. And if you're asking yourself, how does this relate to risk management? It's a very simple explanation, because you have to look at the sector's performance before you buy into any kind of specific shares. If, say, you're going for the tech sector and you want to invest in a tech stock, if the tech sector is falling that day, chances are the stock that you want to invest in, you'll be able to buy cheap, but you're not going to make money off it. And that's, I guess, in a way, kind of like a two-way street. You want to buy cheap because eventually the tech sector is going to go up, but at the same time, don't expect to make money off of it that day. So that's how I determine if I want to do a swing trade or a day trade. If I'm doing a swing trade, I'm looking at for sectors that are down that day and for stocks that are, reaching their lower bands. If if I'm buying it at the lower band, then I know that I could sell in a couple of days and I can make a profit. And if you just looking at this chart, it never fails. If you bought here, sold here, you made a profit. Hit the low band again, you bought here, sold here, you made a profit. Sometimes it's going to stay in the average band and it's going to go up. That means the stock is performing healthy. And when the stock constantly hits the lower band, that means that stock is not a healthy stock. And that is another thing that you got to take into account when you are, looking at the risk or doing a risk assessment of a stock. Because the more it hits the support levels, the more chance there is that it's going to break the support and go down further rather than break resistance and go up further. So you always want to see a stock that's performing at the average level where it's constantly trying to break its resistance instead of constantly trying to fall through support. When it's constantly trying to fall through support, that means that you have a lot of shorts that are pushing the stock down and things like that. Obviously, you always want to adjust your stop losses according to the market's volatility. Some stocks, for example, NVIDIA, they could go up by $1 and they could go down by $3 in one day. So always look at the price of the stock to determine what where you're going to set your stop loss to. If the stock's average movement is it's gaining 25 cents per day, you don't want to set a stop loss of 10 cents, because what is going to happen is you're going to come out of that trade losing money. I promise you will, because no matter what, stocks come and go in waves. No matter how you look at it, no matter how you try to manipulate it, it's always going to be a wave. So always do that, and always try to keep up with fundamental knowledge for the positions that you're in. The more fundamentals the better prepared you are. For example, you want to know their earnings. When is their earnings report date? Any kind of press releases that they have coming out. You know everything about the company. You just want to know. And every single company that is listed on NASDAQ any company that is publicly traded has a website with an investor section. So you could always go to, if you want to buy into OCGN, you could always go to Ocugen's website, go to the investor section and view their pipeline. In their pipeline, they'll show you what drugs they're developing, what day they think it'll be done. And the reason why that is helpful is because you don't have to wait until the, announcement of, hey, we started, phase 3 trials on a new COVID vaccine. And you could see that people started buying in for some reason about 3 days ago, but you're just hearing about this now. The reason why they started buying in 3 days ago is because they went to that website, they looked at their pipeline, they saw that, the phase 3 trials are beginning next week. And right now the share prices are, say, touching the lower band. So they bought in cheap and they're basically taking the risk that the good news is going to come out instead of bad news. And if it does come out as good news, then guess what? You're making profit. Like with NURO, if you would have went to their website, you would have seen that they've been working on this, I think it was fibromyalgia treatment for the past year, and they were expecting results. When they did announce their results, the stock went through the roof to $40. But 2 days prior, the stock already started moving from $5 a share to about $10 a share because of the people that did their due diligence and, early research. They were able to get in a lot earlier. And that is how you manage the risk when it comes to investing into any kind of share that you want to buy. Also, always try to do calculations on your expected return. For example, I'm not going to invest into something if I know I'm only going to get like a 2% return. It's just not worth my time. That especially affects people who do swing trades. The reason why I always say never hold for more than 5 to 7 days is because, first of all, you're tying up your capital. As your capital is tied up, that means you have less money to spend, and you're essentially gonna miss out on opportunities to buy other stocks. We actually had that problem today with one of the guys on the Discord, where I was like, well, why didn't you buy the stock when I called it out? I think it was NRXP, and he said, well, I didn't have any money to buy it. So you always want to make sure that you don't have your capital tied up in anything, and you have money available so you can hop on an opportunity when it presents itself. All right, make sure risk management, pre-market and aftermarket. Is it different? How do you manage risk without being able to set stop losses? Well, pre-market and after hours, you are taking a much bigger risk because there's much less volume. And with less volume, it sounds, kind of, I guess you would say counterintuitive or whatever that word, whatever word I'm looking for is. But, with less volume, it's the same thing as having higher volumes, except now you're taking the chance on that amount of volume. Is it more bulls or more bears? Because during the day, if you have a trading volume of 20 million people or 20 million trades, and pre-market you have a trading volume of 800,000, it's gonna make a big impact if the majority of the 800,000 are buying or they're selling. Also, you could set stop losses for after hours and pre-market. There's only one rule that applies. It has to be limit. Anything that you set, any kind of order that you set that it applies to pre or after hours, pre-market or after hours, always has to be a limit order. You cannot do any kind of other order. So, if you want to set a stop for X amount of dollars, it has to be limited. There's no way around it. For stocks which are going parabolic, for example, NRXP today, how do you determine the price target, or when do you start scaling out? This would be, I guess, a matter of personal preference, because it I guess it all depends on you. I know that if you ask Athletic, he will most likely tell you to start scaling at when you have about 10% returns. Now, I'm a little more greedy, so I start scaling out at 20% returns. But, you want to start scaling out as soon as, you have made a profit, which you're happy with. But determining the price target is a little harder. For example, I knew that, today an RXP would be about 26. I did not expect it to hit 30, but it did. And, there's really any person who gives you an exact price for a parabolic stock is lying to you, because there is no definite math. There's no definite formula for understanding, where that price is going to stop, or when it's going to start dropping off. And there are times we've seen it today where price could go up to $26, back down to 21, and then back up to 30. Why? Because like I said, every time it breaks resistance, somebody's sell trigger goes off. Every time it hits support, somebody's buy trigger goes off. It all depends on how the market is moving and what people are doing. That's where level 2 comes into play, because you get to see supply and demand. So, if this stock is in demand a lot more than there is supply of it, you could expect the price to continue moving forward. However, if you see that people are trying to push the stock off and not a lot of people are buying, then you could safely assume that you could sell that stock at that point. When it hits that low and you see that the demand goes back up, that's when you want to buy again. And then you just, ride the wave back up and scalp it again. Let's see, another question. How much of your capital do you recommend, like percentage for each trade, especially if you have a small capital account? If I wanted to give you the textbook answer, then the textbook answer would be they recommend putting in about 5 to 10% of your portfolio, of your capital, into each trade, because they want you to have a diversified portfolio. They want you to, have a lot of different options. But that these rules were written still, back in the 80s, the 90s. I don't play by them personally. I've had positions where I put 100% of my capital into one stock, like all your eggs in one basket. It's extremely risky. I do not recommend doing it, especially if you're new to trading, because, like, for example, if you have a margin account and you put all your eggs in one basket and that price drops, you could get hit with a margin call, no problem. I mean, and you probably will. At one point in your trading career, you will probably get hit with a margin call if you play like that. It's happened to me several times. But on average, small capital accounts, I would say if you want to have 4 positions open, I would put in about 20% into each position, leaving 20% as a buffer, just available cash on the side, because you always want to have some free cash in your account. You never want to use up all your available cash, or you could put it in a little bit more. Or say you open 3 positions, then you put in 30% in each, and then you leave 10% on the side just in case for emergencies. If the stock price drops, so you don't get a margin call, or so you don't get into any kind of financial problems. Thanks everybody for watching. More videos to come. We usually do them once a week, and I will see you later.